you make a decision, yeah, what data that will change if you do this or if you do that, yeah. So this is very important for you to identify or to calculate, yeah, what data that change, and normally the change in this data will give the effect, yeah. All right, where both cost or revenue vary, or sometimes only revenue change, or sometimes only cost change. Yeah. All right. So it's we want to look at the change in this data actually, right? And then at the end, the net of it. Yeah. Is it better to take this action, or is it better to take the other action? All right. So this is what we call incremental analysis. Yeah. So it is also called differential analysis. Why it is called differential analysis? Because we want to analyze the difference. The change is the difference, isn't it? Yeah. All right. So maybe normally in your everyday life, you will go to work, you have your car, you drive a car, or alternatively, you drive your motorbike. Okay. So which one? Yeah. Which one is better? Better in what? Better in sense of how much it affects your cash flow, isn't it? Yeah. How much it affects your cash flow, which is more saving to do. Yeah. Is it to go on your bike or is it to go on your car? All right. So what's the difference if you go by car or if you go by your bike? So where is the difference? Yeah. So you must calculate this. Where is the difference? So this is why it is also called differential analysis. Yeah. Okay. So are you ready for some figures? Yeah. I really honestly feel that I would like to see you. So please turn on your camera. Can you do that? Yeah. Okay. Thank you. Right. So it also about comparing the alternative. Okay, it's about comparing the alternative. So in this case, yeah, this is a very basic one without having to say, oh, whether this is buy or sell or make or buy. But it is the standard one, yeah, where you have two alternatives, right? And alternative A is you will get revenue of 125,000, right? But your cost is 100,000, and your net income is 25,000. Whereas if you are taking the alternative B, your revenue will be 110, and your cost will be 80,000. And you get net income of 30,000. So what is the incremental difference? Yeah, what is the difference here? Yeah, of course. Yeah, okay. If you take choice B, you will lose 15,000, right? But you will save 20,000 cost. So, what is the net income, or how much better you make? You make 5,000 better if you take alternative B, right or not? Yeah. You understand? Yeah. So the incremental revenue is 15,000 less. If you take alternative B, you save cost 20,000 and you make more income by 5,000. Right? So by this, you can decide already, isn't it? Yeah? Okay. Which is the better alternative now?
B.
Yes. Yeah. B. Okay. Yeah. Better to take alternative B. All right. So can you understand? Basically, this is how it works. Yeah. The incremental analysis, you compare the two alternatives. Yeah. food-based Then let's go on. Right. This is very important. Yeah. This is very important for you to understand. Yeah. What are the cost concepts here involved in incremental analysis? Right. This you have to understand this because you in testing you will be given some relevant costs, some opportunity costs, and some sunk costs, they call it, yeah. And you have to decide which of these costs will be affected when you do the incremental analysis. Some you should include in, some you don't need to include in the analysis, right? So you have to understand, yeah, these three cost concepts. Okay. Right. The first one is relevant cost. Yeah. Well, for the word says itself, relevant cost. So what does it mean? It means that any cost that is relevant to the decision, any cost that is relevant to a decision. If you want to make a decision, you have to think, is this relevant or not? Yeah. Do you need this cost? Will this cost affect your decision? Yes. Yes, it is relevant cost. Okay. So, the only factors to be considered as those costs and revenues that differ. This cost, the change in this, yeah, if there is any change in this cost or revenue, this is relevant. Okay, so cost and revenue. So here they refer to cost and revenue, yeah, that do not differ across alternatives can be ignored. So if they are not relevant costs, you ignore them in the so your pocket, for example, right? Whether to take a bus or whether to drive yourself, yeah. So how can you measure how much you will be affected, how much your cash flow will be affected? Very simple. Okay. So all right. Yeah. So for example, I can mention some example here. You say maybe you have to add. Maybe you have to increase some amount of money if you make this. If you decide this to do this. To do this, yeah. Or maybe additional. You will get additional revenue, right? Okay, but for example, just now I said if you take special order, oh, you say if I get this special order, I get extra revenue. Yes, okay, that is irrelevant. Okay, and then whether if you take this alternative, it will reduce your revenue. Okay, so these are all relevant costs because it affects your decision. Yeah. I don't want you all to be like just a picture to me. Yeah, okay. I don't want to be alone here. Diana, are you there?
Yes.
Okay. Okay. Please stay up with me, okay? Don't leave me alone here. Right. Then the next one is opportunity cost. What is opportunity cost? Yeah. Opportunity cost. So I'm sure some of you are familiar with this, yeah. But it is often when we choose a course, yeah, the company give up on the opportunity, yeah, to benefit from some other course of action. Simple example given here. If a machine is used to make one type of product, the benefit of making another type of product with the machine is lost. Okay, so this is what we call opportunity cost. Yeah, this lost benefit. So the lost benefit is referred to as the opportunity cost. Or I can also say to you the economic value of the benefit you sacrifice under one alternative, yeah, to make available the benefit under another alternative. Sometimes you cannot do two things. You have to decide one, isn't it? Yeah. Okay. So if you decide to do this, yeah, you sacrifice the benefit of doing another one. Okay. So this is the benefit sacrifice or the lost benefit is referred to as opportunity cost. So opportunity cost, is it relevant cost or not? What do you think, class? What do you think? Just think in your common sense. Can somebody say something? Hello?
Opportunity cost, I think is not relevant cost because it doesn't give any difference, right? Because we forgot the benefit.
Mm, we will maybe later we have some examples of it. But basically, opportunity cost, yeah, they are treated as relevant costs. Okay, yeah, because it is included as a cost in making decision. Okay, even though there are no actual costs involved. All right, yeah, but it is something that you need to consider also in making your choice. Yeah, all right. Right. So let's look at the other one, sunk cost. What is sunk cost? Uh, so you look at the photo, there's sunk cost. Costs that have already been incurred and will not change or avoided by any present or future decisions are referred to as sunk costs. Yeah. So that means you have already decided. Okay. And then you have already incurred the cost. I'll give you a good example here. If you have already purchased a machine and now a new, more efficient machine is available, the book value of the original machine is a sunk cost, right? It should have no bearing on your decision whether to buy the new machine or not. So sunk costs are not relevant costs. I think maybe I can give you another example, right? Uh, you you have a car and your car giving you trouble and then you repair your car, okay? After a few months, yeah, you decide to sell the car. Or you say, oh, should I sell the car or should I keep the car? So what happened to your repair cost that you repaired a few months ago? You have already incurred it, isn't it? It is already, you cannot avoid it anymore. So this is an example of sunk cost. So when you decide whether to retain your car or to sell your car, this sunk cost is not relevant anymore. Can you follow? Yeah. Okay. So it doesn't affect your decision, whether you want to repair it, or sorry, whether you want to retain your car or whether you want to buy a new one. Okay. So it's or whether you want to sell your car. Okay. So you have already incurred that cost. So it doesn't matter. Okay. And this one, this example, if you can understand what is the meaning of book value, yeah. What the book value means, this is a new machine. How long the machine is estimated to last? 10 years. And at the end of the 10 years, there's a book value of that. So does it matter for you to make a decision now? What is the value of the machine 10 years later? Now? No. Yeah? All right. The book value, that means the book value is already taken into consideration the depreciation of it. Yeah. All right. So it is not relevant, yeah, in making the decision. So please understand these three important cost concepts, yeah, because it will affect your decision. It will affect your calculation when you do the incremental analysis, whether to include the cost or not to include the cost in your incremental analysis. Okay. And how incremental analysis works sometimes involve changes that seem contrary to intuition. We say only Allah knows everything, isn't it? Yeah. You don't know whether you are making the right decision or not. Yeah. For all you know, you make a decision today and tomorrow something bad happen, isn't it? Yeah. All right. For example, somebody just joined a job, yeah, just got a job and just starting to work. After 1 week, MCO, right? Okay. So you cannot say, oh, I regret working. I should have started my business. Oh no, isn't it? Yeah. So it's sometimes you can't tell what's going to happen. So sometimes involve changes that seem contrary to intuition. Yes. Sometimes you have to do something which is different than you normally would do. Okay. And then you find also there are circumstances where normally we say variable cost will vary, right, to the level of activity and so on. But sometimes variable costs sometimes do not change under certain alternatives. Yeah, so it depends on the condition of our alternatives. And also it's the same as fixed costs. Yeah, fixed costs sometimes change between alternatives. So of course, as far as you are concerned in academics, in learning this part of the decision making, you will be given situations, you will be given the figures, isn't it? You will given the scenarios, yeah. If this change, that don't change, things like that. So it is for you to really think whether the cost involved are affected or not. All right. But in real life situation, you have to face what is really affecting your choices. Okay. Right. So next we look at the types of incremental analysis that we normally do. Yeah. Okay. So common types of decisions involving incremental analysis. Yeah. For example, accept an order at a special price. Yeah. Or you want to make, is it better to buy? Yeah. Component parts or the finished products. Yeah. Or whether um, you have your product, you sell it, or whether you need to further process it. Yeah. Later we look at some examples. Yeah. And then machines or your vehicles and so on. Is it better to repair and then still use it, or is it better to replace? Yeah. Or whether you have to eliminate some of the products or some of your business segments. So inshallah, we will do all this incremental analysis in this topic. Yeah. So if we cannot finish in this one lecture, we'll continue next week. And remember, next week will be your test, according to our schedule. So we'll take 1 hour for the test, and the rest we will continue with our incremental analysis. Maybe by next week we can do more exercises on incremental analysis. Yeah. And of course, I think it is good also to include incremental analysis in your project. All right. Okay. So a short quiz here. Incremental analysis is the process of identifying the financial data that, what's going to be your answer? Nabila? Nabila is the first one to join the class today. What's going to be Nabila Muhammad Amir? What's going to be the answer, Nabila?
A. Do not change under alternative courses of action.
Incremental analysis is the process of identifying the financial data that do not change. Are you sure? What is it going to be? What did I say earlier? We need to identify the revenues or the cost that change, isn't it? Right? Okay? Change, yeah? Because that's what you study, okay? Right? Then you look at the changes, yeah? Whether the changes will tell you that you are doing better or you're making better income or you're making a loss, isn't it? Yeah? All right. So you are analyzing the change under alternative courses of action. Okay, class? Right. So let's move on. Yeah. Okay. This is just something for you to think of. Yeah. No, this is about American Express. Yeah, credit cards. Yeah. So I'm sure most of you have credit cards, no matter what bank is it from. Yeah. No doubt everyone of you has received an invitation from a credit card company to open a new account. Yeah. So sometimes the bank can easily just stop us by the mall, yeah, whenever we're going shopping, and the bank representative will stop you and ask you to open a credit card account for free. Yeah, you fill out everything, details, and so on. The next day you get your card. But some of you have probably received 3 in one day. Yeah, there are so many banks, so many wants to offer you credit cards. But how many of you have received an offer of $300 to close out your credit card account? So remember, this is a service company, yeah? American Express decided to offer some of its customers $300 if they will give back their credit card. So you could receive the $300 even if you hadn't paid off your balance yet, as long as you agreed to give up your credit card. Okay, would you like to get $300 and close your credit card account? What do you think? What do you think? Come on, give me some response.
Yes, and then open it back.
Yes, and open it back. But you wouldn't be accepted in the same bank because you already decided to close it, isn't it? Yeah. But don't forget, you get the $300, but you still have the liability to the bank. Yeah. That doesn't mean that you don't pay the credit card bills. Okay. Yeah. So still, this is a way the company wants to encourage their customers to close the credit card accounts. Maybe because they want to limit the liability that you have with them. Okay, all right. It maybe if you are desperate, you get that $300 cash. Okay, yeah, and you said, yeah, you could be smart and you go to another bank, you open another credit card. Yeah, but don't forget that you still have a liability to pay to this American Express, even though you get the $300. Yeah, but what would be the relevant cost that American Express will need to know in order to determine to whom to make this offer? Yeah, so this is just for you to think of. Right, this is a decision they have to make. Okay, this is a choice where they have to make. Right, they say that okay, it is a good idea. We let the customer close the account, and to encourage them to close the account, we have to give them $300. But they are not offering it to everybody. Yeah. So how do they make this decision? Yeah. And of course, they have to come up with certain figures because remember, they also have to incur $300 each person that they offer, and if this customer accept, isn't it? Yeah. But to what limit do they save in their non-performing loan? Yeah, because banks normally have a problem of non-performing, meaning that the creditors don't pay up, isn't it? Yeah, those who have the credit card accounts don't pay up, so they are also losing. So this is a very difficult decision to make, and of course, if you think this strategy is good, they have to come up with the analysis of their decision is the correct one. Okay, so let's start looking at the illustration. Yeah. O1T Corporation is comparing two options. So here you have two options. The company currently follow option 1, yeah, where they have revenue of 80,000 per year, maintenance expense 5,000 per year, and operating expense of 38,000 per year. Right? That's option 1. Then option 2, they have revenues 80,000 per year, maintenance expense 38,000 per year, and operating expense 32,000 per year. And the additional information given to you, option 1 employs a piece of equipment that was upgraded 2 years ago at a cost of 22,000. If option 2 is chosen, it will free up resources that will increase revenue by 3,000. Okay, so what's your task? Yeah. Complete the following table to show the change in income from choosing option A versus option 2 versus option 1, and of course try to define the sunk cost. Okay, have a look at this. Why don't you work out and write something so that you feel that you are doing something. All right. So the company following option 1. So you fill up the space, right? Option 1, revenue is 80,000 per year. Maintenance expense 5,000 per year. Okay, right? Option 2. Yeah. So fill up those columns and see what you get. What do you think? So first you fill out the revenue, 80,000. So option 1 and option 2, the same, 80,000, isn't it? Yeah. And then it says here that maintenance cost 5,000 for option 1 and 12,000 for option 2, right? Okay, so if you compare, right, the revenue is the same whether you do 1 or 2. And then maintenance cost, yeah, it is more in option 2, right? And then next, operating expense, okay? Operating expense, option 1, 38,000, option 2, 32,000. So option 2 gives you a saving here. And then option 1 has equipment upgrade. So this equipment upgrade is the sunk cost. It's irrelevant, okay? Right? Because it was done 2 years ago. Okay? It's not affecting your decision now. So this is the sunk cost. So in the sunk cost, there is no effect in the incremental analysis. Okay? This is the column of the incremental difference. Yeah? Okay? And Option 2 is if chosen will. If option 2 is chosen, it will free up resources that will increase revenue by 3,000. Okay, right? So there is an opportunity cost, right? So if you take option 2, right, then there's an opportunity cost of 3,000 here. Okay, so I think you will not understand what it means here. Yeah, if option is chosen, it will free up resources that will increase revenue by 3,000. So that means if you do this option, you are not getting this. Yeah, okay. So if you do option 1, you will get some opportunity cost here. All right. So in total, there will be a positive net increase. Okay, so there will be positive net increase. All right, if you do option 2. Okay, if you don't understand, you can always read your textbook again, your class. Yeah, all right. Okay, so we can look at, there are many examples actually in your textbook. Okay, and if you follow the examples closely, it's not that difficult to understand the incremental analysis actually. Okay, yeah, right. So normally what you study is this column. Yeah, what is the net effect? Okay, so that's why the changes in the cost. Okay, so let's move on to more specific situations. Yeah, for this one, accept an order at a special price. Okay, so let's go on with specific examples. This one will be improve your understanding better. Yeah, okay, accept an order at a special price. So normally, so in this learning objective, you have to analyze the relevant cost in accepting an order at a special price. Yeah, sometimes not really accept, so whether it's accept or not to accept. Okay, right. So you need to obtain additional business by making a major price concession to a specific customer. Yeah, I said to you earlier, for example. Yeah, I think maybe a good example, yeah. For example, you are very familiar with Mydin, with Tesco, isn't it? They have so many products. Just think of, let's say, just think of coffee, for example, yeah. Coffee. There's so many kinds of coffee, right? And there's so many brands of coffee selling in the supermarket. And then Mydin said, "Oh, I want to buy." I want you to produce coffee for me, and I'm going to give it a chop Mydin. Yeah, and I want to ask for a cheaper price from you. Yeah, let's say I want to order 100,000 packet of 3-in-1 coffee. Yeah, so he offer you, and you are the coffee manufacturer. Yeah, and then Mydin said, I want to buy from you. This is a special order because I want to put my name on it. Yeah. Okay. So you have to make a decision. Would you want to entertain this request, special order from Mydin, yeah, to produce coffee, but a cheaper price, and also, putting in their own name. Yeah. Okay. So it's your decision. If you think after doing some incremental analysis, you can still make profit by selling to Mydin at a cheaper price, go ahead. Or do you think that you don't want to sacrifice your name and you don't want Mydin to put his name on the product? It's all up to you to decide. All right? Okay? So this is a very simple example that I'm giving to you. Do you think that those brands that you have, Mydin brand or Tesco brand, they produce this product? No, they don't produce this product actually. Yeah, they approach the manufacturers of the similar products and a special order and put their name on it. Okay, right? So sometimes we are paying for the name. Actually, the product could be the same products, but of course we don't know. Yeah, we don't know. The customers don't know. So if they think that it's the brand Tesco, maybe it's a cheaper brand or cheaper product, but actually the product comes from the same big company that produce the quality product because you think it's the name. Yeah, for example, Nestle. Okay, Nestle is very famous with Milo. But if it's another company producing the same product, yeah, Milo product, but not from Nestle, you will still prefer Nestle, isn't it? You would not want to buy Milo from Maiden's brand. Maybe yes. Yeah? Okay. For all you know, they are the same products. All right. So this is sometimes that can happen in a special price, special order. Okay. And in this situation, you must assume that the sales of the products in the other markets are not affected by special order. Okay, so we don't want to have complicated situation. We make an assumption that the sale of products in other markets, so meaning that you if you are the producer of the normal products, you will not be you having the special order will not affect the market. Okay, and they are not these are not affected by the special order. And another assumption that you have to make is assuming that the company is not operating at full capacity. So we always like to assume in incremental analysis, when you have a order at a special price, to make an assumption that your company is not operating at full capacity. For example, every day you have, of course, you have manufacturing capacity, isn't it? Yeah, full capacity meaning that 100%. You are using 100% of your force, 100% of your machine capability. So in normal sense, normally there will always be some capacity that is not utilized. Yeah. So as we have in this incremental analysis, we assume that the company is not operating at full capacity. So since they are not operating at full capacity, when they get a special order like this, they say, oh, why not? We still can run the production, isn't it? We can still do it. Okay. Yeah. Right? For example, I said the nasi lemak order, yeah, the restaurant, when they get the special order, additional nasi lemak 100 bungkus a day in that day, yeah, they say it's okay. We still have some people under work, so we can still get some of them to handle this 100 packet of nasi lemak order special for today, isn't it? Yeah, so they are not operating at full capacity. So this is the assumption that we make, yeah, when we do this analysis, accept an order at a special price. Okay, so let's move on to the calculation. Read this first. Sunbelt Company produces 100,000 smoothie blenders per month. I'm sure a lot of you like to drink smoothie, isn't it? Smoothie blenders per month, which is 80% of plant capacity. So that means they are not functioning full capacity. Yeah. Variable manufacturing costs are $8 per unit. Fixed costs are 400,000 per unit. Okay. So roughly 400 divided by 100, so you can get fixed cost per unit as $4. And the blenders are normally sold directly to retailers at 20 ringgit each, $20 each. Okay, so if you sell at $20 and then your variable cost $8, your fixed cost $4, how much profit you make per blender? Okay, you can easily, you can easily calculate, isn't it? Yeah. Okay, then the company receive an offer from another. Azman, where are you leaving the class? Are you okay? And then the company receive a special offer from Kensington Company, a foreign wholesaler, to purchase an additional 2,000 blenders at $11 per unit. Yep. Arif Azman, yeah, okay. Well, they are selling the blenders at $20 per unit. Now, Kensington want to buy at $11 per unit. Yeah? So what do you think? Should Sunbelt accept the offer? Yeah? Well, the assumption is that even if they accept the offer, it will not affect their normal sales, yeah? So don't worry about that. And the additional units can be manufactured without increasing the plant capacity. Remember, we say they are working below full capacity, so they still have room to manufacture 2,000 blenders. Okay? But look at the price. Kensington wants to buy at $11 only, whereas they can sell it at the retailers at $20. So what do you think? It is better to get the offer or not? Yeah? Right? To take the offer or not? Okay.
No.
So let's do this. So in incremental analysis, normally this is what you do. Yeah, you look at the options and look at the revenue and the cost. Yeah, and of course, depending on the data, how much data you are given. Yeah, then you will look at whether it is a variable cost, whether it is fixed cost that's involved. Yeah. Okay. If they reject the offer, of course, they don't get any revenue. But they will get, if they accept it, they will get 22,000. Right? Okay. If they reject the offer, no cost involved. But if they accept the offer, it's 16,000. Do you know how to get 16,000? Okay. All right. I was trying to go back to the previous slide. Okay. Hold on, we just finished this first. Fixed costs do not change since within existing capacity. Okay. Right. So it's within the existing capacity, so the fixed cost doesn't change. Thus, fixed costs are not relevant. Okay. Variable manufacturing costs, okay, change of course, yeah, and the revenues as well. So these are relevant costs. So let's go back. So the variable manufacturing cost was $8 per unit times the additional order 2,000, you will get 16,000, isn't it? Yeah. Okay, class. I'm just trying to look back how you get the 16,000. All right. So should they accept the offer? Yes or no? Should they accept the offer, the special order? Yes, isn't it? Yeah, because they are making additional income. All right. So this is how you make the decision. Okay. So normally after the relevant, after you prepare this table, you must write your answer. Okay. Okay. Now do this. Please do this. Whether to accept or reject, you tell me the answer. So we can take a toilet break or take a few minutes break. Yeah, class?